CEO of Weiss Research, and Ari Bergmann. He's managing principal at Penso Capital Markets. Gentlemen, it's nice to have you on the program. Welcome.
Thank you.
Thank you. Nice being here.
So, Martin, let's talk about what's behind the move in financials, not just over the last couple of days, but literally about 2 weeks or so. We're seeing a real floor under there and some buying interest. Is it for real?
Absolutely not. It's for real in that if you want to use it as a selling opportunity, it's absolutely a good one. I put Citigroup on our list of banks that are likely to fail in August of last year. And my only regret is I didn't put it on earlier. The point is that no matter how much the federal government infuses in capital and emergency loans, fundamentally Citigroup is going down. I think it's going to go bankrupt.
What would that do to the system? I mean, do you think there's systemic risk?
The system risk is in many different places, not just AIG and Citigroup. Citigroup has $3 trillion of the credit default swaps that have brought down AIG. JP Morgan Chase has more than $9 trillion, or about 5 times as many credit default swaps as AIG. So AIG is not the only one. Citigroup is not the only one that has threatened system risk right now.
So this is, I mean, it's an amazing thing for people to hear that you think the company goes bankrupt and that, you know, you're talking about it as if, well, you know, that's what happens and it's not going to be a system failure. I mean, do you worry?
I didn't say that we're not going to have problems. I don't think it's the end of the world. We are going to survive this. As a nation, we've been through worse before, and we survived. We certainly can survive this time as well.
Ari, what do you think?
I think we are positive on the financials. I beg to differ. I think that we, as an industry, we are well positioned competitively. We are better than foreign institutions. We do have the liquidity by the TGLF that we have the ability there to raise financing.
What are you talking about? These companies are desperate for capital. How are they? How do you say that they have the ability to raise capital and the liquidity position is fine? Do you not agree with Martin in terms of the credit default swaps on the books?
I think the credit default swaps, we have to make a difference and distinguish between credit default swaps on securities and credit default swaps on issuers. Issuers are not going bankrupt, and if they don't go bankrupt, these credit default swaps, they decay to zero. The only issue that AIG had, they wrote insurance on bonds, and those bonds didn't pay. So therefore, we cannot compare apples and oranges.
No, but Citigroup has over $2.60 in credit exposure risk on issuers for every dollar of capital. JP Morgan Chase has $4 in credit exposure to derivatives trading partners for every $1 of capital. Those risks are absolutely excessive no matter how sophisticated your models are. And it's the reason why I wouldn't touch those stocks with a 10-foot pole.
Let me tell you something. These are exposures on issuers. We have these credit default swaps, and I was involved at the start of the market back in 1994. These credit default swaps are only a problem if these issuers go on default. You know, if they don't go on default, they default to zero. Don't compare to AIG. AIG, we're talking about insurance on bonds, and those bonds defaulted. So apples and oranges here.
Well, we're having a lot of the issuers defaulting as well. And, you know, I'm glad you said 1994, because 1994 was the year that the General Accounting Office, now the Government Accountability Office, warned about exactly what's happening today, and no one listened. They explained that there are system risks that go beyond the credit risk and go beyond the issuer risk and go beyond the all these risks that we're talking about. And no one has factored that in. With that kind of a risk, I think you'd be nuts to buy stocks in financials right now.
What about the administration's response to it, Martin? You spoke at the National Press Club in Washington. Can you give us a sense of what you believe the administration has been doing? How's the job they're doing?
Well, the administration is in a bind, and what they don't understand is, and I don't think anyone understands, is that a deflation or a depression is not the end of the world. The goal that they have is, let's avoid this at any cost. But
well, we're not avoiding it.
No, we're not avoiding it, and the cost is far too high. The cost is now, if you sum up all the money that's committed and that's been spent or lent or guaranteed, we're up to $13 trillion, adding in what the Federal Reserve did yesterday. But at the same time, the wealth at the household level in this country has lost almost $13 trillion. So we're on a treadmill, and yet it's at a huge cost to our nation's present and future.
In that speech in Washington, you said that Washington needs to proactively shut down the weak institutions. Which ones?
Exactly. That's going to depend on the examiners going in. I wouldn't depend on my rating to make a determination of which banks to shut down. But there are also many strong banks. And there are banks that are in between that should have a chance to rehabilitate under a slim, fast diet of low-risk lending.
Ari, final word here. What are your thoughts on the Obama administration's reaction to this? Are you getting enough out of Treasury?
I think the Treasury is taking the right steps. I think we are providing the liquidity facility for banks to issue with FDIC guarantee, and they are issuing it at government levels, at very low levels. I think for the first time we are lending and we are getting paid. Financial institutions are getting paid for taking credit risk, and they're paying enough. And I think the spreads are there, and if we give them enough liquidity and time, I think financial institutions as a whole will earn their way out.
Yeah, when is enough? when is when?
I think that we are on our way. We have to understand the market is positioned for a disaster and nationalization. What Martin said, that's what the market is thinking. Conventional wisdom is it's generally not right. Conventional wisdom is wrong.
My wisdom is not conventional. It's very different. And taking over a bank and shutting it down is not nationalization. It's recognized the reality
that's capitalism.
It's recognizing the reality.
But we have only to close banks, and individual banks which are in problems. That's fine. But we have to see the banks, if they do have problems and they have no way to get themselves out of the hole. And we have to focus on the forest and not on just individual trees.
Yeah.
The banks, are they a viable system? And I do think they are a viable system, and the price that you're buying the industry, look at the XLF, is very attractive.
Wrap this up, Martin, go ahead.
Look, with the Fed yesterday saying it's going to buy another $1 trillion in securities, with us up to $13 trillion of government money that's been committed to this crisis, I think we're right now at that point in time, what's called the threshold of the absurd.
Yalla.
Beyond this, it's not happening. It's not working. Too big to fail has failed.
Gentlemen, thank you very much.
Thank you very much.
We will leave it there. We appreciate you joining us. Martin Weiss, Ari Bergman. Great conversation, gentlemen.